Assalamualaikum and hi, we are from Group 5 and we present about the financial ratio of Mr. DIY Group. I will introduce my team members. First, me myself, MUNIFAH. Second, Alia FATIHAH. Third, SITI ZULAIKHA. And lastly, IZZAH SALIHAH.
Assalamualaikum and hi, my name is MUNIFAH binti AZIZ and I will start with introduction of Mr. DIY. Mr. DIY was established by Tan Yuyeh in July 2015 as a consumer hardware store on Jalan Tunku Abdul Rahman in Kuala Lumpur, Malaysia. It is a subsidiary of Mr. DIY Group Berhad and sells home renovation supplies for do-it-yourself projects through both online and traditional retail outlets. It runs over 2,251 retail outlets in 10 different countries across Asia and Europe, such as Malaysia, Thailand, Indonesia, the Philippines, India, Turkey, Spain, Singapore, Brunei, and Cambodia. Then, it operates a number of other businesses as a subsidiaries including Mr. Toy and Mr. Dollar. Furthermore, Mr. DIY vision is to be the largest home improvement retailer in Malaysia and Brunei. Next, the mission is to create a globally recognized retail brand, to offer a diverse retail experience catering to different customer segments, and to maintain a wide variety of good quality value for money items, and lastly, thereby holding true their motto of always low prices. Moving forward to financial ratio. Financial ratio provide information about a company by using financial statement numbers. The statistic on a company's balance sheet, income statement, and cash flow statement used to perform quantitative analysis and evaluate its liquidity, leverage, growth, margin, profitability, rates of return, valuation, and more. And I will be continuing with the first financial ratio, which is liquidity ratio. A company's liquidity ratio indicates its ability to meet short-term financial obligations without relying on inventory and prepayment sale. This approach prioritizes short-term assets for short-term obligation, and liquidity ratio include current ratio, quick ratio, and cash ratio. First, current ratio. The current ratio is used to determine the extent to which demands from short-term creditors are met by current assets. The formula to find current ratio is current asset divided with current liabilities. In 2020, Mr. DIY has RM1.74 in current assets for every RM1 in current liabilities. It demonstrates that Mr. DIY is capable of paying current liabilities with current assets. The current ratio in 2021 is the same, and Mr. DIY can pay its current liability with which its current assets since it has RM2.01 in current asset for every RM2 in current liabilities. Second, quick ratio. The quick ratio is an indicator of a company's short-term liquidity position and measure a company's ability to meet its short-term obligation with its most liquid asset. Apart from that, we can calculate the quick ratio value by dividing current asset minus inventory and dividing with current liabilities. In 2020, Mr. DIY has 24 cents in quick asset for every RM1 in current debt, while for the year 2021, it has 73 cents in quick asset for every RM1 in current debt. While the Mr. DIY are able to pay, this is a sign that the business will have plenty of cash on hand in the future. The last liquidity ratio is cash ratio. It's measurement of a company's capacity to cover all of its present liabilities immediately without having to sell off any other asset or go through any other restructuring. To get the amount of cash ratio is cash must be divided with current liability to get the answer. As example, in Mr. DIY Group, in 2022, the cash ratio of the company is RM2.74, while in 2021, the amount is 33 cents. That is all from me. I will pass the presentation to the next presenter.
Thank you from the previous presenter. Next, I will continue with the efficiency ratio, which is also called activity ratio. This ratio is one to show how effective the company to utilize the assets. In other words, the company use the assets to generate income. There are 5 elements from this ratio. which is inventory turnover, average collection period, total assets turnover, receivable turnover, and fixed asset turnover. Mr. DIY does not have receivable turnover. Next, I will continue with the inventory turnover. Inventory turnover is a measurement on how the effective the company using the inventory to generate income, which is how much time that the company need to convert the inventory to sale. The formula of the inventory turnover is cost of goods sold divided by inventory. In 2020, the ITO for the cost of goods sold is 1,467,819 divided by the inventory is 523,598. We will get 2.80. And for the 2021, the ITO for the cost of goods sold is 1,981,500 divided by the inventory, which is 690,047. We will get 2.87. So now I will continue with the average collection period of DIY. Average collection period is the average length of the time that the company must wait for after making credit sale before receive the cash. In other words, how long the company to get the cash from the debtors. The formula of ACP is account receivable divided by sale, then times with 365. In 2020, the ACP of the account receivable is 127,754 divided by the sale, which is 2,559,315, and times with 365 days, we will get 18.22, which is 18 days. In 2021, the ACP of account receivable is 140,274 divided by the sale 33373 408 times with 365 days, which is we will get 15.18 days, which is 15 days. Okay, so the third element of the efficiency ratio is total asset turnover. Total asset turnover are the measurement of the company effectiveness in using all its assets, which the total asset of the company is being used in order to generate sale. The formula is sale divided by total asset. On 2020, the total of sale is 2,559,315 divided by total asset, which is 2,252,979. We will get 1.14. Meanwhile, in 2021, the total of sale is 3,373,408 divided by 2,700,599. We will get 1.25. The last element is fixed assets turnover. Fixed asset turnover is to measure the companies on how they utilize their fixed asset, which they use the fixed asset to rental or sold in order to convert it into cash. The formula is sale divided fixed asset. In 2022, the sale is 2,559,315 divided by fixed assets, which is 436,331. We will get 5.87. And in 2021, the sale is 3,373,408 divided by 531,225. We will get 6.37. Now we pass to the next presenter.
Hi, my name is SALIHAH binti EDDY, and I will explain about profitability ratio. Profitability ratio is used to measure the firm's ability in using its assets and control its expenses to generate an acceptable rate of return. According to his 2022, profitability ratios are a type of financial indicator that is used to evaluate a company's capacity to create earnings compared to its sales, operational costs, balance sheet assets, or shareholders' equity over time, utilizing data from a single point in time. There are 5 elements in profitability ratios such as gross profit margin (GPM), operating profit margin (OPM), net profit margin (NPM), return on assets (ROA), and return on equity (ROE). Gross profit margin measures the firm's ability to control the cost of goods sold relative to its sales revenue, the relative contribution margin from sales. The formula for GPM is gross profits over sales times with 100%. For 2020, the GPM is 1,091,496 over 2,559,315 times with 100 equal to 43%. For 2021, the GPM is 1,391,908 over 3,373,408 times with 100 equal to 41%. For operating profit margin (OPM), measures the productivity of assets in providing returns to both creditors and stockholders. The formula for OPM is operating profits over sales times weight 100. For 2020, the OPM is 524,708 over 2,559,315 times with 100 equal to 21%. For 2021, OPM is 644,921 over 3,373,408 times with 100 equal to 19%. Net profit margin (NPM) measures the after-tax profit per ringgit of sales after deducting all expenses including interest and taxes. The formula for NPM is net income over sales times with 100. For 2020, the NPM is 337,161 divided by 2,559,315 times with 100 equal to 13%. For 2021, the NPM is 431,827 over 3,373,408 times 100 equal to 13%. Return on assets (ROA) measures a firm's overall return on all of its assets investment. The formula for ROA is net income over total assets times with 100. For 2020, the ROA is 337,161 over 2,252,979 times 100 equal to 15%. For 2021, the ROA is 431,827 over 2,700,599 times with 100 equal to 16%. The return on equity (ROE) measures the rate of return on the investment of the common stockholders or net worth. The formula for ROE is net income over shareholders' equity times with 100. For 2020, the ROE is 337,161 over 876,676 times with 100 equal to 38%. For 2021, the ROE is 431,827 over 1,149,192 times with 100 equal to 38%.
As conclusion, liquidity ratio measure a company's ability to meet short-term obligation by measuring how quickly assets are converted into cash. In 2020, Mr. Diaw's financial statement shows a liquidity ratio of 174 cent. It shows that Mr. Diaw has 174 cent in current asset per 1 ringgit in current obligation. In this case, Mr. Diaw can pay current liability with current asset. In 2021, ratio is identical. Since it has 2 ringgit 1 cents in current asset for every 2 ringgit, Mr. Diaw's can pay its current liabilities. Second, Mr. Diaw's quick ratio is 24 cents per 1 ringgit. If they can pay, the business will have plenty of cash. Then in 2021, Mr. Diaw has 73 cents in liquid asset per 1 ringgit in current debt. Moreover, in 2020, Mr. Diaw had the same issue which they were able to resolve, indicating that the company will have enough cash to cover future expenses. Lastly, in 2020 and 21, Mr. Diaw cash ratio was 2.74 ringgit and 33 cent respectively.
Thank you, previous presenter. Now we continue with the analysis of efficiency ratio. By referring the inventory turnover in 2020, they get 2 ringgit and 80 cent, and in 2021 it increased by 7 cent, which is 2 ringgit 87 cent. Due to this result, it showed that the company is capable to generate the inventory into income. Furthermore, for the average collection period is to find how fast the company can get the cash from the debtor, and from this Mr. Diaw have shown good result in collecting the cash from debtor. In 2020, the days that they need to collect is 18 days, and in 2021 the result is 15 days, which the faster they are able to collect the cash from debtor is the better for the company. As for the total asset turnover, it want to show how effective that Mr. DIY use all the assets to generate income. In 2020, they managed to get 1.14% in generating the asset into income, and 2021 it increased to 1.25%. This has shown that the Mr. DIY is capable in generating the total assets into income. As for the fixed assets turnover, which they use fixed assets to convert it to cash, in 2020 they get 5.87, and in 2021 they get 6.35, which Mr. DIY is able to convert the fixed assets into sale, and which it is a good for the company as they get income from another resources. From all the results above, Mr. DIY can maintain what they are doing now as 2020 and 2021. It show a good result in the efficiency ratio. Thanks. Now I will pass to the next presenter.
According to BIOS 2021, a company's net profit margin demonstrates how the corporation manages all of its business expenses. By referring to the profitability ratio, gross profit margin and operating profit margin for the year of 2021 is lower than 2020, which shows that the cost of materials by the suppliers may have been increased. Therefore, Mr. DIY Malaysia Berhad should find a cheaper cost of materials to reduce the amount of expenses. However, the net profit margin remains the same for both years. This means that Mr. DIY Malaysia Berhad remains the same price for their goods sale. Apart from that, return on assets increased in 2021, which shows that the Mr. DIY Malaysia Berhad is doing well at increasing its profits with each investment it spends. Lastly, return on equity for both years remain the same. This means that the financial performance of Mr. DIY Malaysia Berhad is doing well for both years and has less debt carried by the company.
That is all from us. Thank you.